good day to you all. Welcome to the very first episode of Market Replay. Just to give you a brief explanation or background as to what Market Replay is, what I'm doing in this series called Market Replay is that I will be reviewing the previous day's worth of price data, right? Looking at the charts and analyzing the price data and just highlighting the possible opportunities that were presented to us and the outcomes that might have resulted from taking those opportunities using our trading strategy, which is the candlestick momentum pullback trading strategy, which is taught at Ace Forex Academy. Today I am your host, Koketso Ditlhakanyane, founder of Ace Forex Academy, as well as senior technical analyst at the academy. To not waste any further time, let's get into it. We will start off this episode by looking at the Australian dollar against the United States dollar, right? As I said, and as marked out by my period separators, today is a Friday, so I will be reviewing what happened on Thursday, which was the 9th of July, right? Just to zoom into our charts. First of all, I'd like to start out by marking out the trend and just following the trend, and we'll highlight any opportunities that might have come about, right? So we had brief consolidation, the bulls pushed, the pair higher, right? Bulls pushed the pair higher and we had our area of consolidation, and they pushed the pair higher. Okay, and we had our consolidation and the trend finally changed, right? Before we have this trend change over here, if we move a few candles back, we can then mark out our periods of consolidation which are of interest to us, right? Now we'll mark them out with this yellow square over here. So we had consolidation over here before the breakout, price moved higher, okay, and gave us consolidation again, right? And we'll mark that out using another yellow square, right? Okay, I'll mark out all our consolidation points with the yellow, and we may continue. We will then come back to them and see the possible opportunities that were given to us by the market, right? Let's continue with the trend. Then trend change happened, bears were in control, pushed the market down, further pushed the market down, okay, had our period of consolidation, which we will mark out with the yellow square, and the bulls were back in control, pushing price to the upside, okay. Save our current work, right? Bulls kept pushing price higher, had our period of consolidation from this candlestick, right? Then we had a breakout with this bearish candle, which resultantly so changed the trend to the downside, okay. Let's keep following the trend. Okay, had a brief period of consolidation there, bears pushed the trend low, right? Okay, had our period of consolidation, right, before the bulls got in control and pushed trend to the upside. Okay, bit of consolidation, bears were in control again, push trend down. Okay, this was quite a fight. As you can see, the bulls then came in and pushed the market higher. Okay, and they continue to push the market higher. Okay, then the bears came in and pushed the market lower, right? Then the bulls came in, pushed the market higher. Okay, market got pushed lower again, right? Had a further push to the downside, further push to the downside, push to the upside, push to the upside, brief period of consolidation. Okay, before the breakout, and they continue to push the trend to the upside. Okay, brief consolidation, and then the trend finally changed towards the downside, right? Pushed it further down, pushed it further down till we had our period of consolidation, and we mark that out. Bulls got in control, pushed the market to the upside. Bears came in, pushed the market down, and we closed off in our period of consolidation. There we go. Right, let's just save that. Now what we want to do is go back and revisit our areas of consolidation, right? Starting off with this consolidation, and as you can see in our consolidation period, we then had our pullbacks, right? So I'll mark the beginning of our consolidation and the breakout, and let's understand what then happened on a lower time frame, right? Let's go to lower. Let's have a look. So price pulled back, okay, came back and hit our support over here, right? They bounced off our support, failed to break through. Okay, would have waited for some form of confirmation, which was this engulfing pattern, and you could have entered towards the upside, right, and followed the bulls as they pushed the market up on the close of this candle. Now, using our modified Fibonacci tool, you could have gladly taken a more than 1:1 risk reward ratio, right? We're looking at possibly 1:3 or 1:5 risk reward ratio, right? And that's using a very tight stop loss, which you place at the bottom of this breakout candle. But if you wanted to place it at the bottom of the swing movement, you are looking at a greater 1:2 risk reward ratio, right? And this is how you would have taken this buy position from the consolidation that we marked out on our highest time frame, which was the 15-minute chart, right? Let's go back to our highest time frame and let's mark out the next period of consolidation, right? Just this period over here. Okay, go back to our lowest time frame. Let's understand what happened. Remember, your lowest time frame gives you a better story, right? We then had the development of a swing high over here, right? And price then came back and gave us a swing low with a bounce on our support level, right? And you would have then waited for a confirmation before entering, which is the close of this bullish candle, and you would have continued and taken a buy position over here, right? Pull out our modified fib tool. Okay, using a tight stop, there we go. We would have taken at least 1s2 1.5 for our risk reward, meaning if we risked $1, we would have made $1.5, right? And this is how you would have taken a buy position at this pullback region that we have marked out from our trend on the highest time frame, right? Let's remove that. Let's visit our next consolidation area. Okay. This is the next consolidation area we had. Okay, mark the trend change that we have over there. Move to the lowest time frame, right? As we can see, what did we have here? We had the development of a swing low, right? This was our swing low. Okay, price came back, hit our resistance level over here, rejected our resistance level, right? What I always tell my students is that you should be careful of your swing points. Always mark them out, right? Because we don't know, or we have two outcomes that may happen when price hits your swing level, right? Number one, price can reject it and have a change in trend, which is what we have in this case, or price can come back, okay, and break through your swing level and further push the trend to the downside, right? With price bouncing off our resistance over here, what you could have then done, waited for confirmation, okay, which was the close of this bearish candle that we have over here, and using our fib tool, right, using our modified fib tool, we can then plot our take profit regions. So using a conservative stop loss, meaning placing your stop loss over there, what we can then see is that this was not a favorable trade to take, because at most our swing low over here gave us a resistance zone at our 50% TP, meaning that I would have then had a risk reward ratio of 1:0.5, which is not favorable, right? You don't want to risk more than what you can potentially make from a trade, right? And that's using a very conservative stop loss, right? But using a more aggressive stop loss, okay, you would have then had the chance of making 1:1, right? Meaning if you risk $1, you're going to make $1 from this trade, right? And as we can see, entering right on this sell opportunity on the close of our confirmation candle, we can then see that our swing point, which gave us our support zone, was sitting right at the 100% TP, right? Meaning that we had a 1:1 risk reward ratio, right? So depending on your risk management, you can then decide if you're going to be more aggressive with your stop losses or more conservative with your stop losses, right? Are you going to give the market some room to breathe, or are you expecting the trade to move into your direction as soon as possible, right? Your trade, are you expecting it to move in the direction you forecasted as soon as possible, right? And this is the outcome we could have had from this particular setup that we have over here, right? Let's move on to our next consolidation period. Okay, mark it from there. Right, and let's move further down. Right, we can spot the same setup over here. Number one, we have the development of our swing to the upside. Number two, price came back and bounced off our support level, right? And as price bounced off our support level, what then happened? You waited for the close of the confirmation candle, right? It's always important to wait for the confirmation close, right? And you would have taken a buy at this position over here, right? Yet again, let's forecast using our modified Fibonacci tool. With a conservative stop loss, you're looking at a risk reward ratio of around 1:1.5, right? Remember, we had the development of this swing level that we have over here, right? The swing high that we have, and this gave us our resistance zone, right? And as you can see, with a conservative stop loss, you are looking at taking a risk reward ratio of 1:1.5, right? But then with a more, this was with aggressive stop loss. With a more conservative stop loss, we're looking at a risk reward ratio of 1:1 from this particular trade, right? So if you had a more aggressive stop loss, you then had a better outcome, right? But remember, the problem with having a more aggressive stop loss is that you might get stopped out some of the times, right? Or more times that you'd like to, because you do not give the market enough room to breathe, right? But with a more conservative stop loss, we were looking at our zone over here, and our 100% was sitting in the zone. So this was giving you a signal that price might come in and break through, or price might reject the zone and turn around like it did and move back to the downside, right? And this is how you would have then approached this particular trade, just using your 2 time frames, right? Let's move on to our next one. Just the zone that we had over here. Okay. Move on down to our lower time frame. Right. This was a very interesting trade over here. So you can check, had the development of our swing low, right? And with the development of our swing low over here, okay, let's just mark out, it gave us our support region, right? So mark out your support region. Okay, this was our support, right? Price then came and hit our resistance, right? Price came, hit our resistance, but we never got any confirmation right up until trend finally changed, right? So we wouldn't have taken this particular trade, and it would have saved us, because if you can notice over here, trend changed to the upside and trend came back down again. So you would have been stopped out on this position if you entered without the confirmation close past this low that I have marked out over here, which is this low, right? You're supposed to wait for confirmation close past that low, but this vertical line then indicates that trend changed, right? And because trend changed, we never had confirmation to enter, we were saved. All right, that's how we would have taken this trade. And let's move on down to the next consolidation period that we have. It's this one over here. Okay, as you can see, guys, I am basically just copying and pasting a certain way of entering and exiting the market, right? That's all you do. With price action, it's predictable because history repeats itself, right? All you have to do is understand history and then apply it in future, and that's basically how you then trade, right? With a strategy that is very consistent. If you do not see your setup, do not trade. All right, it's not bad that you don't have a trade in a day. You may have days where you don't have trades. There's nothing wrong with that, right? That's the market. Some days the markets are ranging, some days the markets are just biased on one side of the trend direction. Okay, do not mind that. All right, you just stick to your strategy and only enter once your strategy tells you that it's time to do so, right? Having a look at this period over here, what we can then see is that price pulled back, right? Hit our support, and once it hit our support, we needed a close past this high over here, right? And we eventually got our close or our confirmation with this candle over here, right? Let me mark it out for you. But now what the problem is, do you notice how close it is to our resistance level, right? I'll mark that out too. Notice how close price is to our resistance zone, right? And as you can notice, you are entering right into the resistance zone, which doesn't make sense, because when you forecast a 1:1 or 1:2 risk reward, it's far beyond this region. And looking at history, or looking to our left, we notice that price has been rejecting this zone, right? Even in the close of our confirmation, you can still see the rejections. So when price closes within your zone, it's only logical to expect a higher probability towards being rejected in this zone. And this is what happened. We had our fake out, we had our fake out, we had our fake out, and price pushed back down. So learning how to understand what's happening on your left, which is your history, is very important, because it will help you when you are forecasting or finally making the decision to enter or exit the trade, right? In this case, we would have not taken this trade because price closed within our zone, all right? And that's how we would have been spared from a loss in this trade, all right? Let's move on to our next consolidation zone, just this zone over here, and let's have a look, all right? There we go. This was quite a big zone, as you can see. What happened was that price came, right? It hit our resistance level over there, right? There we go. Price hit our resistance level. We were waiting for a confirmation close past this low over here, right? And remember, you've got to understand what's happening on the left so that you can forecast towards your right hand side, right? And by realizing that, we then notice that we have this swing level right here at the bottom, okay, which sits right on our resistance level, right? That's our whole entire swing region at the bottom, right, giving us our support region over there, okay? And let's look at how entering on the close of this candle would have played out, right? First of all, we'll forecast using a more aggressive stop loss, okay? With a more aggressive stop loss, you're looking at making around 1:1, right? 1:1 risk reward ratio, which fell within this region over here, right? And with a more conservative stop loss, like pulling it right to the end, we were looking at almost a 1:1 as well, right? So sometimes, as I advise my students, is that once you enter a trade, right, when you have a certain amount of pips, or let's say you forecasted at 1:1 and price hits your 50% level, what you want to do is then place a positive stop so that you can guard yourself from any sharp turns that can happen while you're waiting for your position to be hit, which is your take profit. So in this case, we will have had a positive stop close to 0%, because 0% marks our entry area, right? And we would have been stopped out once price bounced right before hitting 100%. But with a more aggressive stop loss, that was not going to be necessary, because if you notice, price hit our 100% before it then turned around and went to the upside. And that's how you would have approached this particular trade in question, right? Let's move on to the next consolidation zone that we have, which is this final zone over here, okay? And price closed in consolidation, because we can see with our period separator here that the day would have ended with us waiting for a possible outcome on this trade. And because I am a day trader. I do not hold trades overnight, right? So this would have been the end of my day, and I wouldn't have taken any position looking at the time, right? This is close to the end of the day, so I do not trade at that particular time. That's part of my trading plan, right? But just to have a look at it and see what might have happened, let's scroll. Here we go, right? This is our trade. What do we have here? Let's understand. On the left we have the development of our swing high, right? Here's our swing high, okay, and our swing high gave us this particular resistance level over here, right? Let's mark it out. Okay, price came and broke our support, right? But remember, it's only our highest time frame close that then confirms whether our support or resistance has failed, right? This was a general a basic example of a fake out, right? So you are going to enter a buy position at a close past that high, which was this bullish candlestick that we have over here, right? And using our Fibonacci, modified Fibonacci tool, what we can then see is that this candle, with a more conservative stop loss, we had a good risk reward ratio that far exceeds 1:1.5, right? And with a more aggressive stop loss, you then had a risk reward ratio that sits in the 200 region. So you would have made a good trade from taking this trade. You would have made a good outcome from taking this trade. We're looking at 1:1.5 and 1:2 as a risk reward ratio. And guys, as that marks the final consolidation period, this is how we would have approached our trading session on the 9th of July, which was on a Thursday, right? This is how we would have traded that particular day. As you can see, this day was filled with lots of opportunity for us to enter into our trades, right? We had good risk reward ratios. We took nothing less than 1:1, and yeah, the trades really played out very well. We were saved from a couple of losses, which are a good thing. You can't avoid losses. Sometimes your analysis may tick every box that you have, but simply based on the fact that we cannot fully predict where the markets will go. Nobody has the ability to predict with 100% accuracy where the markets will go. It still goes wrong, but we are just grateful that it didn't go wrong this time. Price told us not to enter and we didn't enter. We listened to the charts, we marked what was happening on the left, and history gave us good forecasts as to when to enter, when to exit, and what to watch out for. I trust that you enjoyed the very first episode where we were looking at the Australian dollar against the United States dollar, looking at price data that happened on the 9th of July, right? This is following the Ace Forex Academy candlestick momentum pullback trading strategy, right? If you enjoyed the video, please do leave a like, please do subscribe, and yeah, leave some comments on the video. If you'd like me to look at a certain pair for you for a particular day, please do, and I will do that for you in the next video that we'll do. And stay tuned and see you in episode 2. Thank you.